It is not that I intended to spend time on tariffs today. There are already countless discussions on the subject from every possible angle. But when I glanced at my own stock portfolio, I couldn't help but notice that the debate has grown too significant to ignore. Mainstream discourse claims that imposing tariffs is largely a political gesture designed to boost domestic manufacturing and prevent other nations from gaining an unfair economic advantage. Many critics have dismissed these measures as misguided, arguing that Trump and his team lack a sound understanding of economic fundamentals. In today's discussion, however, we will consider another perspectiva scenario in which these aggressive trade measures are part of a long-range strategy to resolve the United States' most urgent short-term challenge, the ever-escalating national debt. Imagine for a moment a young person with a steady income. In more prudent times, he would save up over several years and eventually buy everything he desires. Instead, he insists on immediate gratification. Moreover, he wants to project an image of luxury and financial abundance to those around him. So what choice does he have? He borrows money. This is exactly the point that many of us stress to students and young professionals. It's not having little money that is dangerous, it's the practice of taking on high-cost, predatory loans that can spiral out of control. Consider a simple scenario. Many online lenders might claim that borrowing $1,000 comes with only a few cents of interest per day. In reality, however, the effective annual rate on these loans is often well above 10%, and in some cases even as high as 15%. Suppose a young person borrows $10,000 at an annual rate of 15%, planning to repay in 3 installments. The interest for each period is calculated as follows: $10,000 multiplied by 15%, then multiplied by 3/12 or 0.25, which is 10,000 0.15. 0.25 $375. Therefore, after 3 months, his repayment is 10,000 plus 375, totaling $10,375. On its face, an extra $375 might seem manageable. However, if the borrower driven by immediate consumption finds himself unable to repay the original loan, he will borrow again. This time, he borrows $10,375 to cover the old debt. If this cycle repeats, his debt will gradually snowball. For instance, after a second 3-month period, his total debt might grow to approximately $10,375 multiplied by 1.0375, accounting for the added interest, roughly $10,764. By the end of the third period, 9 months in total, his debt could reach around $11,167, and after 4 periods of full year, his total debt might be approximately $11,586. In effect, an initial borrowing of $10,000 results in an additional $1,586 accrued in interest over the year. This means his debt multiplies by roughly 1.1586, corresponding to an effective annualized rate of about 15.7%. This snowball effect clearly illustrates that when borrowing is used for immediate consumption, the debt gradually increases until monthly earnings can no longer cover the ever-growing interest. It is for this reason that we constantly advise young people, even those beginning their careers, that while having little money isn't the worst fate, taking on high-cost, predatory loans can prove devastating when compounded interest steadily amplifies the amount owed. Now, consider how this same principle is at work on a national scale. The United States is much like that young person capable of earning well, yet prone to spending far beyond its means. In 2024, the federal government reported revenues of about $4.9 trillion and total expenditures of approximately $6.75 trillion, resulting in an annual deficit of around $1.8 trillion. However, that figure alone hardly captures the full scope of the fiscal challenge. A critical aspect is the cost of servicing the national debt. While earlier analyses mentioned an annual interest expense of roughly $1.1 trillion, current projections from the Congressional Budget Office indicate that net interest outlays for fiscal year 2024 are about $870 billion, with expectations for fiscal year 2025 exceeding $1 trillion. Even with these revised figures, the burden remains substantial when compared to the economic output of many mid-sized economies. If the nation continues borrowing new funds solely to cover these interest payments, it is entirely possible that in a few decades the annual revenue will fall short of covering even the interest charges, setting the stage for a potential fiscal collapse. Historically, governments have sometimes operated under the philosophy of short-term optimism, live for today, as the saying goes, without paying heed to the long-term consequences. When funds ran short, previous presidents simply raised the debt ceiling and borrowed more to maintain a facade of prosperity. Many of these leaders, advanced in age, deferred the reality of future crises to later generations. This philosophy has allowed the national debt to rise steadily, around $3.2 trillion in 1990, roughly $5.6 trillion by 2000, nearly $27.7 trillion in 2020, and now exceeding $36 trillion in 2025. During his first term, President Trump was noted for his aggressive spending strategies and policies aimed at stimulating short-term growth. In his subsequent term, his ambition extended further, not only to maintain high levels of spending, but also to fundamentally transform the nation's fiscal structure in order to relieve America from the burden of enormous debt. His economic vision evolved from the familiar slogan of bringing manufacturing back to America to a far more ambitious goal to overhaul the nation's fiscal framework and break free from the cycle of relentless borrowing. This shift in perspective is encapsulated in what has come to be known as the Mar-a-Lago Accord, a term used by leading financial outlets such as Reuters and Bloomberg to describe a suite of proposals aimed at rebalancing U.S. fiscal policy. What exactly is the so-called Mar-a-Lago Agreement? Currently, there is no definitive information on its specific details, but some insights can be drawn from a report titled Reshaping the Global Trade System, drafted by Stephen Moore, who chairs Trump's Economic Advisory Council. In this report, Moore aligned his views with his superiors, focusing on the state of U.S. manufacturing. He noted that the decline in American manufacturing affects not just the factories themselves, but also the broader range of industries that support these facilities, ranging from bars to restaurants. Without sustaining the factories responsible for even the smallest tasks, many Americans may soon lose basic job opportunities, from dishwashing to cooking. To maintain the status of the U.S. dollar, the report explains that America must continue to export dollars, while other countries, in the interest of market stability, are compelled to hold significant U.S. dollar reserves. This situation drives a growing global demand for the dollar, which in turn can lead to its overvaluation. An overvalued dollar increases production costs for U.S. manufacturers by making imported goods relatively cheaper and exports more expensive, a challenge that many view as a key factor in the prolonged decline of American manufacturing. Under the Accord, the first step is a complete overhaul of the nation's debt instruments. The proposal calls for foreign creditors, including major investors from Japan, Europe, and other key economies, to swap their current interest-bearing U.S. Treasury bonds for 100-year, non-tradable zero-coupon bonds. Recent data shows that some foreign holdings have declined. For instance, one prominent investor's holdings have fallen to around $759 billion, the lowest level since the early 2000s, while Japan still holds over $1.06 trillion in U.S. debt. Under current conditions, U.S. Treasury bonds have yields typically in the range of 4.2 to 4.5%. If these bonds were exchanged for century bonds that pay no annual interest, the United States could, in theory, eliminate roughly $300 billion or more in annual interest expense. Essentially, this would be akin to telling creditors, "I acknowledge I owe you, but I cannot pay you now, repay your principal in 100 years. The second step employs trade policy as a diplomatic tool. Instead of imposing tariffs solely for domestic protection, the United States would adopt a differentiated tariff system as part of a broader negotiation strategy. Under this plan, nations that agree to participate in the debt restructuring, for example, by converting a portion of their holdings into non-interest-bearing bonds and that contribute more equitably to shared defense spending, will receive preferential tariff treatment. Those that decline to cooperate would face significantly higher tariffs. This reframing of tariffs transforms them from instruments of mere protectionism into levers of international diplomacy, intended to stimulate a broader, cooperative approach to addressing America's fiscal challenges. The third component of the accord is the modernization of the nation's asset base through the revaluation of key assets. A prime example is the U.S. gold reserve. For decades, the gold held by the United States has been recorded at a historical value of around $42 per ounce, a figure that is far below the current market price, which is close to $2,000 per ounce. Revaluing these reserves to reflect the current market would dramatically enhance the nation's reported net worth. Additionally, the proposal envisions establishing a national reserve composed of digital currencies, an innovation that recognizes the importance of digital assets in today's economy and serves to diversify the nation's asset portfolio. The fourth element focuses on targeted currency policy. The proposal suggests that the United States adopt measures either unilaterally or in coordination with international partners to encourage a depreciation of the U.S. dollar, while simultaneously promoting the appreciation of the currencies of its key trading partners, such as the euro and the yen. A weaker dollar would make American exports more competitively priced in global markets, potentially spurring a shift of manufacturing back to domestic soil. Although such currency interventions are complex and carry inherent risks, from a U.S. perspective, the potential boost to export competitiveness and the redress of long-standing trade imbalances are significant incentives. The final element of the accord calls for a reallocation of national security costs between the United States and its traditional allies. Historically, the United States has borne a disproportionate share of global defense expenses, while its allies have contributed relatively less. Under the new proposal, traditional allies, especially those within NATO and key partners like Japan and South Korea, would be required to increase their military spending from roughly 2% of GDP to about 5%. Furthermore, existing security treaties would be renegotiated to ensure a more equitable distribution of defense responsibilities. This rebalancing is designed not only to ease the fiscal burden on the United States, but also to create a more sustainable and cooperative international security framework. Together, these measures constitute an integrated strategy aimed at breaking the perilous cycle of borrowing to cover interest payments, a cycle that has pushed the national debt to unsustainable levels. Critics of aggressive fiscal measures have long argued that drastic tariff policies and sudden debt restructuring can trigger unintended consequences such as higher domestic prices, disrupted supply chains, and international retaliatory actions. Numerous studies, including those from the Peterson Institute for International Economics and Analyses by major financial news outlets, have documented that previous tariff measures typically increase production costs and reduce competitiveness. Traditional perspectives favor gradual, measured reforms that avoid destabilizing financial systems. Proponents of the accord, however, contend that the magnitude of current fiscal imbalances leaves little choice but to pursue bold, transformative measures, arguing that incremental reforms have merely postponed an inevitable crisis rather than addressing the underlying issues. In conclusion, the Mar-a-Lago Accord, with its proposals to restructure debt through a swap for 100-year zero-coupon bonds, to use differentiated tariffs as diplomatic tools, to revalue national assets, to implement targeted currency measures, and to rebalance defense spending among allies, offers a provocative and integrated vision for addressing the United States' deep-rooted fiscal challenges. But one must ask, are these proposals based on firm facts, or is it a case of overthinking? We need to observe the subsequent developments in the Trump administration to see whether future policies will follow the Mar-a-Lago Accord's plan. There remains a simple uncertainty: what is China's stance? The future is full of uncertainties, and on a personal note, I hope my stocks will bounce back. If you enjoyed this video, please subscribe to our channel.